that lower put protection buying has resumed after the first 40 minutes of trade post the breach of 7,000. But having said that, we are right now hovering near the 7,000 mark and haven't lost it materially. The total accumulation of open interest in the February series, the maximum amount lies at the 7,000 put. Should that give away in a major way, that will be an important indicator going forward, because some support is at least seen at the 7,000 level right now. A breach beneath that materially and some shedding in terms of open interest on the 7,000 put will be important going ahead into the second half. That hasn't happened till now. So at least till now you are seeing some support at the 7,000 level, even though we are a tad beneath that. But having said that, the indications are negative. If you talk about the ratios of FIIs and options, the put longs to call longs remain double at 2:1, and there's heavier call writing, of course, at 4:1 in favor of the calls. So the structure remains bearish, and this has continued since December. There's been hardly any change in that, and the PCR remains at lower levels of 0.8.
Fair enough. That's the market technicals, the market internals. But how do things stack up for investors? I've got two guests joining me, Mohit Gaba from the technical side, and I have Sameer Dalal from Natwarlal and Sansa. Thanks both of you for joining us. Sameer, I'm going to start off with you. The markets continue to be weak, and this is really underlying all the nervousness that is and the uncertainty that is reigning across the world. What is your advice to investors at this point? Because a lot of people are spooked. The SIPs have turned negative in terms of returns. There is a lot of disenchantment building up, even though the headlines are not looking that bad. What are you kind of warding off from your clients?
Yes, absolutely. Like you said, whenever anyone's looking at their portfolio, be it the mutual fund investments or direct equity investments, portfolio managements where they're given money to manage, there are no returns. In fact, they're negative returns. And this is kind of creating a panic, which is accelerating and creating more of a problem. Now, simply put, the FI selling has continued unabated in the cash markets for the simple reason that the ETF withdrawals that are coming in, as long as you see more and more withdrawals globally in the global emerging market funds, you will see selling continue. So that is one problem. Now, luckily, what has happened in the recent past was the domestic institutions were able to kind of counter that and hold, put up their own. But as you rightly said, last month SIPs have reduced, fresh investments in mutual funds are coming down. You're actually hearing a lot of talk of redemptions in the mutual funds starting to pick up, which could accelerate the problem. So even though I believe the downside is very limited, I don't see the market going too far down given the current valuations, given that we are staring at a budget where the government could actually pass through a lot of good investment investment themes and things like that. So even though these negatives even these positives are there, I still say that it might make a little more sense to wait, a couple days, maybe just let's see where the market starts settling. I have been bullish. In fact, if anything, I'd always a couple days ago recommended that on corrections, whenever you get an opportunity like this, put in some amount of your money into the market. So I'd continue to say that, yes, selectively put money into the market, into stocks which throw up valuations which are quite attractive, where the problems are not as
fair enough. Got the message, Sameer. We've got a lot of stocks to cover, so I'm going to button over here. Mohit, let me get you in on this. What are the levels that you're watching out for? I'm sure you have a more bearish take in the immediate turn right now.
Well, so far the Nifty looks negative. There are no signs of positivity or strength in the Nifty. However, it's trying to hold out between 6,950 and 7,000 zones, where we saw support 2 days back from on Friday. So far it's still negative. However, to initiate fresh shots at present levels is not the best. It's not the best entry point. Hence, best is to just wait and watch and see if we give way to 6,900 levels or the previous lows of 6,869. Okay. So we're going to wait for that.
I'm going to move to the bank Nifty before I get this news on how Standard & Poor has downgraded a couple of bank stocks. But I'm going to ask you, Bank of Baroda, after that big move up on Monday, is still in positive terrain if you look at the last 5 days. The rest of the bank stocks are down.
Absolutely.
Relatively, is that indication that it might be better, or is it just a quantum of the way it has gone up that it has not fallen as far?
See, on the day of the results, we saw really bullish price action on Bank of Baroda, and it's still holding up, So it's still a buy. I feel it's trading above 130. It's actually trading at 134 levels right now, and I still maintain it's a buy because I think it's bottomed out. You've seen it cross previous swing highs, which were at 134 levels. So Bank of Baroda is the only bank that's actually looking good on the charts. It's maybe a very good entry point from a risk to reward point of view right now.
Fair enough. Let's get to the news around banks. Standard & Poor has revised its outlook on Bank of India from stable to negative. This after the bank's gross NPA for third quarter stood at 9.18% or 35,600 crores. My colleague Shraddha joins us with the highlights of that report. Shraddha.
Well, Standard & Poor's has revised Bank of India's outlook to negative on the back of weakening asset quality and potential deterioration in capitalization. They expect asset quality to weaken over the next 12 to 18 months, and on the back of that, they even expect earnings to remain weak for the next one and a half year. They believe there's a high likelihood of support to come in from the government of India, and they're expecting the government to provide a timely and sufficient extraordinary support as far as capital is concerned for Bank of India. Nevertheless, they believe credit costs are likely to remain high, as 71% of the domestic loans have been made to corporate, micro and SME segments which are under duress. They're anticipating a loan growth also to moderate to about 0 to 6%, so flattish single digit number as far as the loan growth is concerned. And in fact, S&P has also warned that they may downgrade Bank of India if gross NPL ratio crosses or rises to 10 to 12%. Remember, the current GNPA stands at about 9.18% or about 35,600 crores versus the bank's market cap of close to 7,000 crores. So this does not really come as a surprise given the fact that the bank's net loss widened to about 1,500 crores in Q3 FY16, and in fact the management warned of more pain to come ahead. So a negative outlook coming in from S&P as far as Bank of India is concerned.
Fair enough, Shraddha. Thanks so much for joining us with that. Just an alert, of course, Bank of India is looking weak, down 2.8%, but it's not the weakest link in the banking sector. In fact, Yes Bank is down about 2.9%. And if you look at the last 5 days, you'll see that Punjab National Bank is the worst performer. That's down about 11%. Followed by Bank of India and Canara Bank. It's a bloodbath. The only stock which is up is really Bank of Baroda and Axis Bank if you look at the last 5 days, and in the last 1 day, well, only Bank of Baroda is up 1.9%. So it's really just harking back to the concern Standard & Poor has raised. The NPA issue continues to bog down this sector. Sameer, very quickly, what's the outlook on banks from here? Is all the bad news in the price, or do you think there is more to come, more downside?
So first up, it's absolutely perfect that S&P cuts its ratings after the banks have taken such a huge NPA write-off. I think the markets probably knew this before, so what you said is probably correct, that a lot of this negative news is priced in. Now, of course, there are a lot of hidden skeletons which are coming out. IOB, for example, is one of them, which, NPA is going about 12%. So there may be some banks, like maybe even Bank of India to some extent, where NPAs will rise further above the 10%. So those are the banks you want to avoid in the PSU space. But what my previous colleague said on Bank of Baroda, with most of the negative news priced in, the stock is holding firm. I feel there could be upside from the PSU bank space also, only if you focus on the larger 3 or 4 of the PSU banks where we believe that a lot of the negatives are there. It's known, it's priced in. The probability of a default or probability of a bigger run on the bank is not likely to happen. So Bank of Baroda, PNB, SBI are definitely options. Now, everything is known, right? The market knows the situation with steel companies, the market knows the situation with power companies, the market knows the situation with infrastructure companies. It's not really going to get too much worse. So I wouldn't have a very, very negative view on the larger PSUs and the private sector. But yes, for the near term, it makes sense to avoid the smaller PSU banks, even though there's even more value in them. Just that it will take probably much longer for them to come back than it will take for these guys to rebound and give you returns.
Thanks for that. Let's move on to the next stock. BHEL is in focus. It's continue to be weak. Now, whichever period of time you look at, be it 6 months, 12 months, year to date, the weakest link in the market has been BHEL. Of course, in the 1 year metrics, it's Vedanta which is down, but BHEL is down about 60% in the 12-month period. Year to date, it is definitely the weakest link as far as the markets are concerned. It's down about 39.5%, and in today's trade also it continues to be extremely weak. A write-off, Mohit, what is your take on BHEL?
BHL is close to the 100 levels, which was the previous support in 2013. Odds are it'll take out 100 in the days to come, if not today. One can actually short BHEL with a stop loss of about 105 levels and have targets of 95 to 92 in the days to come.
Sameer, would you concur with that view?
Yes, to some extent I would say BHEL is going to continue to show weakness for the simple reason that investment in the power space has not seen any sign of pickup. What they have is their old orders. Orders internationally have also not been flowing in. You saw a very poor set of quarterly numbers coming in. So probability is there's no reason why the stock should rebound. Yes, and it could probably drift downwards.
Fine, fair enough. That is what is happening. HCL Technologies is the other stock in focus. Of course, the rupee is extremely weak as well. And I'm going to quickly start with the rupee and how it is slid as far as the dollar is concerned. And there you have it, it's 68.65. Mohit, I don't know whether you look at the rupee at all, but we have continued to slide, and our currency has been a late mover against the dollar. Do you see this slide exaggerated in the near future? As a chartist, do you track it at all?
Unfortunately, I don't have the INR dollar charts, no currency charts, so it's not fair I comment on it.
Sameer, how are you, working around the rupee weakness and the persisting rupee weakness? Because there was a time when the rupee weakened and we looked at the tech companies saying that the profits would be better, but that day is far gone because, there's so many other concerns out there.
Absolutely. So a weakening rupee bodes well for even tech companies and pharma companies as of today. So it will definitely help their profitability without a doubt in the Indian rupee terms. But the problem is India continues to remain a net importer of products, right? And the weakening rupee only hampers the situation. To some extent, this crude oil price, which has fallen from $100 to $30, we've not been able to get the full benefit of it because our currency has probably over that period gone, from probably like 55, 60 to about 68. So we've lost some of the benefits for that could have come from that point. So I'm not very sure, and that a rupee depreciation at this point is a very, very good thing for India. And yes, maybe some IT companies would benefit, but as a overall, I'm not very happy with the fact that it's declining like this. Second thing, the decline also, I'm not expecting it to happen too far for the simple reason that right now we are seeing a bit of redemptions from FIIs, which is taking money out of the system. I do believe that yes, it might take some time, but these FIIs will come back. I still believe India is probably a stronger country. Our current account deficit is slightly better than what it was in the past. We are a net importer of crude, which is a big benefit. With the prices coming down. So overall, I don't see too much downside. I think the rupee will probably stabilize around these levels. So I'm not too concerned on that, but yes, a depreciation is not good for India.
Fair enough. Interesting bit of news coming in on HCL Technologies, which could become the first major Indian company to list on Wall Street in 8 years. What does this mean for shareholders? What is the reason behind this decision or this move by the company? My colleague Piyush joins us to discuss this move. Piyush, we haven't seen an Indian company try and tap the US markets for a very long time. 8 years is a long time. What's the rationale right now?
So I think the clear rationale is what Infosys tried to do in the 90s. They basically want to broaden their investor profile. So for a company which has been doing well since many years, their returns have been in top quartile. But if you look at the multiples, it's trading at a very high discount to TCS. So if HCL Tech basically goes out and gets listed its ADR, what it will do is it will increase profile in the international market, get them the international investors, and basically increase the liquidity for them. So it will overall naturally boost their multiples. So I think what company is trying to do is widen the investor base, widen the investor appeal, and basically boost the overall share returns basically.
Yeah. But, what time frame are we looking at possibly for this? Because with the global markets in turmoil, it's perhaps not the best time to go on a investor meet and yatra right now.
Yeah, but I think when you're going for an idea, it will usually take you anywhere between 6 to 15 months at least. So even if they are able to go through the entire process, I think second half of this year, and anyways, we are expecting that, and basically the street is estimating that the second half of this year should be better. And for an IT company, even in the case of a depreciating rupee, it should not be that bad for HCL Tech.
Fair enough. Let's get Sameer's view into this. Sameer, HCL Technologies on the back of this news, what do you think of it?
So actually, I'm not even sure whether it's fresh funds raised or they're just going to, list some of the shares over there. Now, if it's just transferring some of the shares from the Indian markets over there, it's going to have a zero kind of impact. But if it is a fresh issue, there'll be some amount of fund flow into the company, which would allow them to probably look at more acquisitions for growth. So we need to see more clarity on what exactly they're planning on doing and what the plan, why they want to do this, and it'll be easier to comment on that. But if I look HCL Tech at the point of view, it's not very, very expensive. Neither is it very, very cheap. So I wouldn't initiate fresh longs based on this news, but neither would I look to sell out of HCL Tech at this point. So it'll be like a hold situation.
Okay. Mohit, HCL Tech and the tech pack, we haven't spoken about the tech pack for some time. How do they look on the charts?
HCL Tech is broadly trading sideways between 800 and 880. It's a range bound trade with a slight negative bias. But even if it breaks downside, on the downside it breaks 800, I still see strong supports at 770 to 750. So HCL Tech for now is an avoid. If it drops a little, maybe you could buy it around the support level. But for now, let's just let's avoid HCL Tech.
Okay, fair enough. I think we leave it over there, but let's go broader on the markets. In a market like this, it's very difficult to take individual stocks. Many of them are gyrating to the big shorts in the positions which is being built up on individual stocks and the kind of pressure that we are seeing on the sell side. But we did ask Sameer and Mohit to identify the stocks that they think are good bets for at least the medium term or short term. I don't know which term they're looking at, but I've got the list with me, and let's quickly go across to each one of them with their list. Sameer, your stocks are HDFC Bank, L&T, Infosys, Ultratech and ITC. Quickly, what is the rationale for the picks and what time frame are you looking at?
So I would give it a 1 year to 2 year time frame. So simply put, L&T and Ultratech, two of the companies, so I was on your channel on Friday, and what I discussed is the whole government spending theme that is going to be coming out post the budget, the investment in infrastructure. Now, Ultratech in the cement space is probably one of the better players. He's still able to grow his capacities. He's doing some acquisitions. He's not very highly leveraged. I think he's well placed. I think, yes, valuations are not very, very cheap, but once the utilization levels for cement companies turns, I feel Ultratech will be one of those that benefit, and you could see good upside from these current levels over a year and a half. L&T falls in the similar theme. Any infrastructure investments, EPC players would benefit. Larsen is one of my largest EPC players in the country. People have become overtly pessimistic on that counter, and I think there's more value to L&T than the market is giving it. So I feel from a point of view, from 2 years, you could easily get maybe 1,500 to 1,600 on the stock. So there's good upside potential for both of these from that side. Now, HDFC Bank, being a retail banker, has been doing extremely well. The stock has been down, and there's a lot of talk that it's the FI selling that's pulling the HDFC Bank stock down. I want to just correct this a little bit. There's not that much FI selling in HDFC Bank, because there's a category on the exchange where FIs can trade individually in HDFC Bank because of the limit up in that stock. That is still selling at a premium of 15% to the current market price. So it's not FI selling, it is domestic institutions that are probably looking to reshuffle the money that they have. HDFC Bank valuations are still rich. Some of the other banking spaces, stocks where the valuations have corrected, you might see some amount of shift of money. So I think HDFC Bank is, it's got good growth ahead of it. It's got the best asset quality. poised for growth. I mean, everything is in place for this company. So I like HDFC Bank. Yes, valuations are a little expensive, but I think the premium for valuations will remain for a while because India still has a long way to go for its banking sector. So quite positive on that. Coming back to the other two, Infosys, IT space, I believe IT is still has a lot of potential. Of my IT stocks, Infosys is the top pick because of the fact that they are innovative, because of the fact that they're able to adapt the business models quite fast, and some of the thought processes that the new management has come through with. The valuations are not as expensive. Yes, growth has taken a bit of a slowdown at the near term, but I believe the growth in IT will only rebound maybe once more digitalization and more of these Internet of Things and all of that comes up. So I believe there's a huge way to go for the IT space. And which was the fifth one?
ITC.
ITC, yes. ITC is one of the best plays in India. The stock has been butchered out of shape for the simple reason that excise duty on cigarettes has been continuously increased. Now, yes, it has had a near-term impact with some amount of profitability coming off because of volume reduction. But if you look at it over the history, and if what I believe is to be true, India's youth population, is trendy, and they think it's a cool thing, hip thing, all those things, and I believe the cigarette volumes will rebound. Now, in the FMCG space also, yes, they've been in this industry for the last 7-8 years, and they're putting more money behind it, and people are worried why, because the return on capitals are low. But look, once you get some scale, once you get some size, and then when you can leverage on that scale, I think the profitability will come in. The business is good. So from that point of view, I think again ITC is being discounted a bit too much by the Indian markets. If I look at it from a year point of view, I'm easily looking at
fair enough. It is the run up to the budget, and normally ITC does underperform at this time in anticipation of excise hikes. Once again, we don't know what is going to happen this time, but in the last couple of budgets, that has been the story. But let me also get Mohit's views in the market. Mohit, your set of stocks are Cipla, Divi's Labs, Gale, Mindtree and Motherson Sumi. What time frame are you looking at, and what returns can people expect from this?
I'm looking at the extremely short term time frame, maybe intraday